we speak to clients, we often hear the argument that, well, we've heard about this inflation story a million times, and we heard about it in 2008, and inflation was the dog that didn't bark. Big monetary policy easing, no inflation. So I'm going to ask a question to the panel, and I'll go around to I think most of you, and ask for one argument for why is the post-COVID crisis different than the post-global financial crisis. So let's start, well, we just had Michelle. Let's start with Michelle. What do you think is the most important difference, or an important difference today versus the 2008 experience?
The biggest difference, and we've talked about this a number of times this week, is the fact that the policy response post COVID is going to be very different than what we saw post the global financial crisis. I mean, we obviously had massive amount of both monetary and also in the COVID crisis, fiscal stimulus, which we didn't have obviously during the financial crisis. And the important thing was the difference is in the wake of the global financial crisis, as soon as things looked better, as soon as the recovery looked to be taking hold, there was a quick reversal, the interest to reverse all of this stimulus that had been put in place when it was so needed. And that was particularly true on the monetary front. I mean, I think about the Fed wanting so desperately, as soon as they could, to get off the zero bound in order to have ammunition in case the economy slowed, to be able to cut rates again. Now we're looking at a very different situation. The Fed has actually shifted to, average inflation targeting. It is clearly signaled it is not going to be quick to reverse course. It will encourage, it will tolerate an inflation overshoot. It's not going to be preemptive in terms of reversing course. And I think that's going to be a theme that we see echoed actually with central banks across the globe. So that's a very important difference. The lack of a quick reversal on the policy front that really differentiates, I think, the post-COVID crisis period from global financial crisis period.
Great. So next in line, I'm going to give Kevin a shot. So Kevin, policy is different this time. Give us another argument.
Well, I'd also follow up on the fiscal side, being that we saw an enormous amount of fiscal stimulus relative to what we saw in the wake of the 08-09 crisis. So I think that too, there's just a lot of uncertainty that could trigger a little bit of upside risk from that perspective as well. And then I'd follow it up by, the improvement that we've seen in the recovery has been much quicker and much stronger than expected. I think, the drop in the unemployment rate alone, while, some workers have fallen out of the labor force and presumably some of them will get back in as things recover in 21. But I think, this recession was certainly much different and much more orchestrated to try to combat the virus rather than, an overheating in the economy or if you go back to earlier times when inventories really swung the business cycle. So I think this is certainly a different backdrop that inflation could reaccelerate as we begin to show some improvement in the back half of 2021.
Great, thanks. So I'm going to give Ross and Giovanni a quick shot. So I want to make sure we get to Q&A. So in 30 seconds or less, any other differences to add this time around?
I think the supply side is, more complicated and more uncertain. The V-shaped, if you like, nature of the economic shock. And as of today, maybe versus our expectations 6 months ago, the scarring, the lasting damage perhaps doesn't look as bad as was feared. So perhaps by at least initially removing less production output capacity, you will dampen that initial upside inflation shock. But I would tend here to stress the uncertainty around supply. You obviously can't measure it directly. It's something that has to be estimated. But this is clearly going to be a massive challenge for central banks in coming to a view about just how big and how persistent output gaps are.
Giovanni, anything else to add?
Yeah, one specific point on Europe, I would say, because in the previous crisis, we had a very strong monetary response, but no fiscal response, but also for political reasons. because the euro area was unable to react. And now we have it. This is a big change. And I think that this will have an impact on, general demand in Europe specifically, and of course for fiscal policy. And it's something that can change the profile for inflation, in the years ahead, basically.
All right, so I'm going to sum up. So much more monetary will, much more fiscal will, much more political will, a supply shock that we may be underestimating. I'm going to throw one more in there, which is that the health of the banking system this time around should not be underestimated. The banking system played a big blockage for inflation back in 2008, and that just frankly is not a problem this time around. So we've got some time. I'm going to shift to Giles, and we want to talk a little bit about the foundations for inflation that were in place before the crisis. So we talked about things that, as a result of the crisis, can push inflation higher. But was that foundation there? And if it was, what were the foundations for higher inflation pre-COVID?
Yeah. Hi. Okay. So thanks very much. I mean, I think another few points actually I would have just added, that I think we're in the mix just after the global financial crisis, which turned that into a very deflationary period. We had globalization and digitalization, which were really just hitting their stride. We had China and Eastern Europe being integrated, and that was a major shock. Then we had the Euro sovereign crisis, which was a particularly big hit in Europe as well. And finally, of course, we were talking a lot in the period, sort of 2014 onwards, really, about Japanification and aging. And so, now when I think about what's changing, we've got a lot more caution about globalization, which seems to have been slowing in any case. Migration has peaked, I think, in Europe, 2011 really in the UK, 2015 in Germany, a little bit more recently in the US, but I think that's something that's been accelerated by COVID as well. And aging, aging is a complicated one. The simplest theory is that it's related to life cycle, because when people retire, they may consume less, and that's really what a lot of the discussion has focused on. But they also produce nothing. And it's quite possible that there's a non-linearity, there's a kind of tipping point. And we may be going through it now. If we take Germany as an example, its population bulge is now in its late 50s. And the delta of people entering retirement is clearly on its way up. So, I think that there were a number of pre-existing themes which were already changing as we entered this crisis. And as has been widely remarked, this crisis may turn out to accelerate many themes. And I think that we can count some of these among them.